Before we dive into the strategy, we must acknowledge that the tax sale of the early 2020s is over. Rates have reverted to their previous 2018 levels. This means the 12 bracket is back to 15, and the 22 and 24 brackets have climbed higher. However, this does not mean Roth conversions are a bad idea. In fact, if you believe tax rates will continue to rise in the future to address the national debt, 2026 might still be one of the cheapest years to convert your traditional IRA or 401k. The core concept of bracket planning. Bracket planning is the process of intentionally filling up your current tax bracket without spilling over into the next higher one. Think of your tax bracket as a bucket. If you are in the 15 bracket and you have $20,000 of space left before you hit the 25 threshold, you can convert exactly $20,000. You are choosing to pay 15 now because you fear you might be in a 25 or 30 bracket during your retirement years. Step 1. Calculate your taxable income baseline. You cannot plan a conversion without knowing your starting point. You must look at your predictable income sources. This includes your salary, Social Security benefits, pension payments, and interest or dividends from your brokerage accounts. Subtract your standard or itemized deductions from this total. The number you are left with is your floor. This is the foundation upon which your Roth conversion will sit. Step 2. Identify marginal breakpoints. Once you have your baseline income, look at the 2026 tax tables. Identify the top dollar amount of your current bracket. For example, if you are a married couple filing jointly and your baseline taxable income is $8,000, you are firmly in the 15 bracket. You need to look at exactly where the 25 bracket begins. The gap between your $8,000 and that next threshold is your conversion zone. Step 3. Count for stealth taxes and phase-outs. Bracket planning is not just about the federal percentage. You must be aware of stealth taxes. A large Roth conversion increases your adjusted gross income. This could trigger higher Medicare Part B and Part D premiums 2 years from now, a system known as IRMAA. It could also cause more of your Social Security benefits to become taxable. Always calculate the effective tax rate of the conversion, not just the marginal rate. Step 4. The multi-year conversion ladder. The biggest mistake investors make is converting a massive sum in a single year. This pushes you into the highest possible tax brackets and creates a massive tax bill. Instead, use a multi-year ladder. By spreading a $500,000 conversion over 5 or 10 years, you keep the income in the lower brackets every single year. This compounding tax savings can result in hundreds of thousands of dollars of extra wealth over your lifetime. Step 5. Paying the tax bill. To maximize the power of a Roth conversion, you should never withhold taxes from the conversion itself. If you convert $100,000 and take out $25,000 to pay the IRS, you only have $75,000 left to grow tax-free. Ideally, you should pay the tax bill using cash from a taxable brokerage account or a savings account. This allows the full $100,000 to move into the Roth IRA, where it will never be taxed. Again, why 2026 is the year to take action. The expiration of previous tax cuts has created a sense of urgency. We are now in a higher rate environment, but history shows that rates can go much higher. By locking in your taxes today at known rates, you are buying insurance against future legislative changes. You are creating a tax-free bucket that provides you with incredible flexibility in retirement. You can choose which account to pull from to manage your income and keep your future tax bill at zero. Summary of the strategy. Success in 2026 requires precision. Start by projecting your income early in the year. Consult with a tax professional to ensure your calculations for the new 2026 rules are accurate. Monitor your investment gains throughout the year. If the market dips, that is often the best time to convert, as you can move more shares for a lower dollar value. This is called converting on the sale. Thank you for watching this deep dive into 2026 Roth conversion bracket planning. Taking control of your tax destiny is one of the most powerful things you can do for your financial future. In the 15% bracket, you have a golden opportunity to convert assets that would otherwise be taxed at 25% or higher during your retirement years. However, this requires a surgical level of precision in your financial planning. You must start by calculating your modified adjusted gross income with extreme care, because even a small error could trigger what we call the tax torpedo. This includes understanding how a Roth conversion might interact with the taxation of your Social Security benefits, or how it might push you into a higher Medicare premium bracket through IRMA. Many people forget that a Roth conversion in 2026 will impact your Medicare costs in 2028 because of the 2-year look-back rule. This is why bracket planning is not just about today, but about managing your future liabilities. Another sophisticated layer of this strategy involves the timing of your conversion during the calendar year. While many people wait until December to see their total income, I want you to consider a tactical approach based on market volatility. If the stock market experiences a significant correction in the middle of 2026, that is exactly when you should pull the trigger on your Roth conversion. By converting when asset prices are low, you can move more shares of your favorite mutual funds or stocks into the Roth environment for the same tax cost. When the market eventually recovers, all that growth happens inside the tax-free shell of the Roth IRA, meaning Uncle Sam will never see a penny of those gains. Furthermore, we must discuss the importance of having a dedicated tax fund. You should never use the proceeds of the conversion itself to pay the IRS, because that diminishes the power of compounding interest. Instead, you should identify assets in a standard brokerage account that can be liquidated to cover the tax bill. This allows your entire traditional IRA balance to transition into a tax-free status, where it can serve as a powerful legacy tool for your heirs. Remember that under the current rules, inherited Roth IRAs provide incredible flexibility for your beneficiaries compared to traditional accounts, which are now subject to the 10-year distribution rule. In summary, 2026 is a year that demands proactive management and a clear vision of your long-term tax trajectory. You are not just moving money from one account to another, but you are essentially buying out the government's future share of your wealth at a fixed price. Today, stay disciplined with your numbers and keep a close eye on the marginal breakpoints of the new tax code to ensure you are maximizing every single cent of your retirement portfolio.